So I absolutely believe that Bitcoin can go to $1 million. If all the world's capital decided to allocate 5% to cryptocurrencies, because cryptocurrencies are this new asset class thing that they have become convinced is something they need in their portfolio. And this could include central banks through cryptocurrency reserves, in addition to gold reserves. I think that calculation is the answer to what happens to cryptocurrencies.
Sergey Nazarov, welcome to CoinDesk Spotlight.
Thank you for having me.
Sergey, first things first, hard-hitting question here. Are you Satoshi Nakamoto?
No.
That was, I guess, a little bit of a viral moment on the internet at one point in time. I know that folks have called you now the Satoshi of oracles. I want to start here. When folks were saying that, when you hear people say the Satoshi of oracles after that, what does that title make you feel, if anything?
I mean, I'm pretty proud of what our team and the Chainlink community have achieved by building this first of its kind Oracle network infrastructure. And it's enabled blockchains and smart contracts and DeFi to go to, let's say, the next stage of their development. Before we built it, everything was kind of stuck in the very, very early days of tokenization. And after we built it, DeFi grew from less than 100 million to over 200 billion, and now has gone beyond that with Chainlink powering the majority of it from the start up until now at approximately 70%. And in many cases more. On many chains like Ethereum, it's way more. So I feel very proud that there's this large group of people that I've had the opportunity to work with. And then there's a few select people that I'm, really grateful to for all the immense effort and the sacrifice that they've made to build this really interesting technology. So I think someone who has the privilege to build useful technology is a lucky person, and so I feel pretty lucky.
Sergey, when you talk about the oracles that you've built, and I know we'll probably discuss a lot on the oracle side, it really feels to me that the oracle systems were one of the first ways that we were able to bring utility into blockchains. The idea that you could connect on-chain data with off-chain data was something that I think people loved the idea of theoretical, but really what you guys built was something that connected the dots in a very, very substantive way. Can you tell us about those early moments of why an oracle was necessary in your opinion?
Sure. So in the early days of our industry, let's say 2014, 15, from a tokenization point of view, that's when that all started. Tokenization was kind of limited, and also you couldn't build many smart contracts that did anything particularly useful with the tokens. Decentralized finance and the ability to generate lending markets is the first big use case of smart contracts beyond tokenization of an idea, right? Most cryptocurrencies are tokenization of ideas rather than real systems. There's a few exceptions like Bitcoin and utility tokens that are used in systems to pay for computations. But of the tens of thousands of different cryptocurrencies that have been generated, many of them are still in the idea tokenization. Here's an idea, let's make a token about the idea, something like an NFT or something like that. The first real value use case, I think, was DeFi, because it allowed you to get yield off of these tokens. And then the second use case was stablecoins and the ability to tokenize a real world thing. In this case, US treasuries or cash, and represent a form of payment on chain that isn't so volatile because it's connected to some random idea that someone made a token around. I think that in the early days, it was just making the most valuable and obvious use cases possible, which are lending markets. And lending markets generate yield, which is basically what banks do, right? So banks in their simplest form are a place where you can deposit money and they can give you a yield back on that money. So your money is held in a system somewhere, something takes custody of the money, and then it returns a rate of return, a yield. And that's kind of the basis of banking in addition to what they do on the lending side and giving out loans and how they generate the yield. But from a consumer point of view, DeFi let you basically have yield for the first time in a smart contract driven way, not in a CeFi or centralized exchange driven way. And many of those CeFi lenders, because of how they operated and that was very unclear to people, are out of business, while the DeFi lending systems are still massively growing. And I think that says a lot. So I think that smart contracts evolving to do more is really what Oracle networks are about. And the lending markets was the first big evolution of that, which was the first version of doing what a bank does on chain, separate from the concept of issuance, right? So issuance is one concept, and most issuances were about idea coins, not real underlying assets other than stable coins. And then you had the functions of a bank. And so Chainlink enabled that first function of a bank in terms of lending and yield generation on chain with Aave as the prime example.
Sergey, can you take us back to 2014 when you're starting to build the first iterations of Chainlink? What was going on for you? What were your, I guess, perceptions or yeah, I guess your perceptions of the financial systems? What personal problem were you trying to solve? Like, why did you want to dedicate your life to building this for the next decade and more?
I think there were like two or three key realizations. The first realization was that smart contracts are poorly named, in that smart contracts are named after smart things. So smart home, smart car, smart card, smart fridge. There was this period in the 90s where everything was going to be smart in the sense that it was connected to the internet. And all those other things that I mentioned are connected to the internet, but smart contracts are actually not connected to the internet. So they're not connected to APIs or any of these other systems. And so basically what you find when you really look at smart contracts is that they really shouldn't be called smart contracts in that sense, because they're not connected. And then when I walked around and talked to a whole bunch of people, they didn't understand that. So right there, what you have is called opportunity. You know something that other people don't know that seems important. Okay, so then the question is it important? And the more I looked into it, the more I realized it's pretty important, because these smart contracts are not going to be able to do anything other than three things without connection to the internet and APIs and other contracts and other chains and all these other systems. And the Chainlink white paper from the beginning was about data oracles as well as cross-chain oracles as well as other types of oracles. So the second realization is, okay, what can smart contracts do without connectivity to other contracts and other chains, or to data sources, or to the internet, or to these other systems? Well, they can do three things. They can, ingest private key signatures. They can process those private key signatures against a set of conditions. If I get a signature, then I do X or Y. And they can have token ledgers. You can generate a token ledger, and you can, do conditional things around that token ledger, like exchange. If I send you 3 tokens of a certain type, you can exchange those for 2 tokens of another type. Okay, so that's tokenization, that's multi-sig and private key ownership control of tokens, and that's basically decentralized exchange, because the token information that you need is all encapsulated on chain from the beginning. Everything else is outside of blockchains. It's not possible. If you want to generate a financial product, if you want to generate insurance, if you want to basically do anything that a bank does other than issuing some kind of ownership record, you need oracles. Okay, so the second realization is, wow, I know something a lot of people don't seem to understand, and it seems to be really important, at least for this thing, for this smart contract thing. And so when we were building smartcontract.com, and before that Secure Asset Exchange, and before that CryptoMail, smart contracts were just being understood. I would say there's probably like a couple of thousand people in the whole world that even knew what smart contracts were at all, and probably a few hundred that knew how to work with them relatively well in any useful way, because they were really hard to work with. And then the third question is, well, is this smart contract thing going to go anywhere? Or is it going to be a niche industry with a couple of thousand people knowing about it and a couple of hundred people knowing how to do something with them? So if the answer to those three questions is yes, wow, I know something that other people seem to not understand at all. This is actually really important what I know, because if this doesn't get fixed, then this smart contract thing doesn't really go much further. And this smart contract thing seems like it's going to go pretty far. And when I was looking at this, I think the whole smart contract market was like below 100 million, probably tens of millions. And so it's actually a question at that point, right? It's not like an obvious thing. We're not talking about trillions of dollars in smart contracts. We're talking about 20, 30 million total in market value. And everyone is saying, oh, this will get regulated out of existence, or I don't understand what this is, doesn't make any sense. And so you have to kind of make a decision about that third point, that smart contracts make sense. And smart contracts, I think, do make a lot of sense because they eliminate basically risk. So the risk that you have when you deal with an institution is that people can decide to do things about your contract. Basically, that's called counterparty risk. But your counterparty risk with smart contracts is basically the details of the contract, you understanding them correctly, and them being done and executed correctly against technology. So you have tech risk. When I looked at the difference between tech risk and people risk, I really would much rather myself have tech risk than people risk. So if I had a choice between contracts where there was tech risk, and the tech risk was infinitesimally small because you had decades of the system being run successfully and reliably and secure, or you had people risk, like Silicon Valley Bank is people risk, Bernie Madoff is people risk, Enron is people risk, 2008 financial crisis, people risk, Greek monetary sovereign debt crisis, people risk, the future fiat and sovereign debt crisis, people risk. People risk doesn't have a great track record, just to be super duper clear. Pretty much people risk is bad risk. Technical risk, much better track record. And so when I looked at it that way, I think I saw that if you can do everything that people do in smart contracts, then you can shift it from people risk to tech risk. And that was another thing I realized people don't understand, is they just don't understand. People still don't understand what smart contract. They still don't understand.
Sergey, I have a quick question for you, because when I think about AI, I think about it as the future of humankind, right? And we're talking about people risk versus tech risk. Does that start to blur with the evolution of AI? Does people risk almost become tech risk in a way?
Well, AI is, I would say, a new form of tech risk. The type of tech risk that I was talking about is a smart contract that's pretty limited in what it can or can't do, where all the conditions of what it is going to do or not do are extremely clear. And so you can verify what the lending market can or can't do. You know that the lending market can't withdraw your money into the CEO's wallet, can't do it. You know that the collateral in the lending market information will always be available to you, always. You know that the lending market can only do these three things. Can't do four things, can't do five things, just three things. That's all it can do. Can't do anything else. You might want it to do something else, but it can't. AI is not very well understood from what I can tell. People cannot explain how AI comes to the conclusions that it comes to, why and how it has hallucinations, why and how it will behave in future versions. So the amount of conditions that you have with AI is not the three conditions of a lending market contract, or the two conditions of a multi-sig contract, or the one condition of a signature that can transfer a Bitcoin from me to you, according to the Bitcoin protocol. It is actually thousands and thousands of conditions. And many of those conditions are unknown and they're unpredictable. So for me, AI represents very large tech risk, basically. Now, could you get AI to the level where it becomes very predictable what it's going to do? I think you could. Is it possible that you limit AI through smart contracts and private signatures so that whatever the hell it wants to do, it can't do unless the signatures and the smart contracts coincide with what it wants to do? That's an interesting, a combination of these technologies. But I think AI is a probabilistic technology, while smart contracts are a deterministic technology. So the smart contracts mathematically guarantee outcomes to you, namely those three outcomes, and no others, under all circumstances, repeatedly. And AI, apparently, even when asked the same question multiple times, can probabilistically give you different answers. So I would say that the AI in its current version is a large amount of tech risk. That's how I would view it. We are working and are successfully being able to merge AI capabilities with smart contract asset transfers, value movements, and the way we're doing that is by actually running multiple AIs in an Oracle network and comparing their results to reduce the probabilistic nature of the AI outcomes. And then we're also making sure that the Oracle network only allows a very narrow set of outcomes to happen from the AI results. So the Oracle network is kind of limiting what the AI results are able to do in relation to smart contracts. But I don't think that the people risk side of AI is going to be the problem. I think the problem is actually going to be that the AI is going to be so good that you won't be able to create proper risk management of its behavior. It's actually going to be the lack of people that's going to create the problem in the case of AI. Unless you can get to some set of guarantees that the AI system cannot behave in ways that people wouldn't agree with, which could be Oracle networks, which could be private key and smart contract limitations on AI. Those are all things we're implementing, but I think it's a different type of tech risk.
Sergey, I want to go back a little bit to what you were saying. You find yourself in this situation where you're seeing this opportunity, which is for us to make DeFi real, we need Oracle networks, and we need to figure out how to do that. And at the time, it sounds like you're saying, hey, there's tens of millions of opportunity in here, but we see that this could become larger. I'm interested in what got you to that moment in terms of what was your entry point into the crypto space. And based on, your background, which combines a variety of interests, you seem pretty well designed to be interested in this idea of decentralization and blockchains and sort of newer technology systems that could reimagine the world through a different lens. And so I guess I'm interested in how did you find yourself in 2014 in the position where you were starting to see what could we do with smart contracts and with oracles?
Sure. So I was an early miner. So the way I got into this industry was as a miner. There were three groups in 2010 when I was getting involved in the Bitcoin industry. There was no blockchain industry that didn't exist. That didn't exist as an idea. There was just the Bitcoin industry because Bitcoin was the only chain and the only token. And there were three groups. There were the speculators and the people that just kind of held Bitcoin and had ideological views around holding. There were the miners. And then there was the small group of the cypherpunks, the small group of people that understood and built and debated and thought about the future of Bitcoin and how to move it forward. I was in the miner group. So I was in the group that looked at this and said, okay, I have excess GPU capacity. let's try this mining thing out. And that's all you could really do until you had something called Namecoin appear. So Namecoin was the first, what was then called altcoin or appcoin. Those were the two first terms to describe coins or chains that were other than Bitcoin. So there were altcoins, appcoins, and I think altchain were the first terms. I think it was altchain. And Namecoin was the thing that made everybody kind of go bonkers, because what Namecoin did is it said that you could have a DNS system. So you could have a domain name system. It's basically what ENS tries to do now. And the Namecoin system was really interesting because the DNS system is not decentralized as people think. So the domain name system of the internet actually affords certain level of control to certain groups. And so then you had this idea of, okay, well, there's Bitcoin, and Bitcoin is country agnostic money, or like institutional, free of institution money, or government unaffiliated money, which is interesting, right? Because all money and all currency is affiliated with government. It wasn't a store of value. It wasn't digital gold. It was actually currency, right? So the idea of Bitcoin was currency that was not government based, not as a store of value. That was not the initial idea. That's because the Bitcoin price was low, right? Bitcoin has this amazing property that when the Bitcoin price is low, it's a currency for microtransactions. And when the Bitcoin price is high, it's a digital gold store of value. It has this amazing ability to morph between these two things depending on the price. At that point, the price was pretty low. I mean, we're talking below $1. And so you're kind of in a world where everyone is talking about government fiat currency being a scam. And there's a lot of people that believe that. Even in 2010, after 2008, people are looking at this and they're like, okay, so we're going to print money and we're going to bail out banks. And I'm supposed to believe that the money that I have in my wallet isn't going to get devalued if every time there is a institutional loss, that loss gets socialized against the value of my currency and my my domestic economy. And there's a lot of people that even 2010 didn't believe that. So I got into it from that minor point of view. I'm pretty skeptical of fiat currency. I think fiat currency is like it's an experiment that has been done in the past in England when they started diluting the value of the coins. So they took the coins and they diluted them with other metals. That's when I would say that fiat currency started to really come into existence. That ended up not working out great. I don't know if the previous 70-year experience and experiment now of fiat currency is going to end in a good place. It's very possible that it'll end in currency and fiat currency debasement. So I was attracted to something that's an alternative to fiat. I was attracted to this idea that you could mine. And so I started mining. And then I was just kind of like involved and learning about what this is. So when the first things came around, I was kind of just there, and I just was at the meetups, and I was on the message boards, and I knew what people were saying and how it was looking. And then it all kind of really picked up around 2014, where you had more chains and more altcoins and app coins beyond Namecoin appear. And that's when kind of just made the decision that if you can make all of the relationships that people have guaranteed mathematically through smart contracts and through blockchains and through private keys, that's a different way for the world to work. And that's just attractive to me, because I don't really need to trust in a person in an institution or a government at that point, because I can trust that the smart contract will always behave correctly. People still don't understand that. They really still don't understand that. They view our industry as some kind of place of something speculative, or some model of better transaction settlement that's faster, or something about automation, or some new market that they want to be involved in. They still, most people, vast majority of people, and some of the people I would say even maybe in our industry, don't fully understand that this is about guaranteeing outcomes that could not be guaranteed before. And the value of that, I think, and I thought back then, is immense. And I think it is immense. Because people, when if you really look at it, there's so many things that go wrong. Insurance policies don't get paid out. People buy fraudulent concert tickets. Ad networks have huge levels of fraud. There's huge amounts of real estate fraud, huge amounts of financial fraud and settlement issues, which is why it takes 3 to 4 days to do payments through correspondent banking, and a whole bunch of other problems. And that is all basically because the counterparty risk that you face in an insurance company and the person selling you a concert ticket in the ad network is just really poorly constructed and able to be exploited at large cost to you, frankly, and large risk to you. And so if all of the stuff can work in a deterministic, mathematically guaranteed way, that's still an idea I don't know if people understand. It's not something people have seen applied to enough things to fully understand it, unfortunately. But I can see it being applied to insurance, global supply chains, ad networks, concert ticket sales, the whole financial system, all of it, really all of it can be turned into a smart contract. And then that smart contract will have to verify things, and it'll have to connect to other smart contracts. And you don't need to prove identity. And this is the body of work that me and a few other people have decided is worthwhile. Because if you want to expand smart contracts to all those use cases, that's not going to be just with a blockchain. It's just not possible. You're going to need something that's going to verify all those conditions, connect all the contracts across chains, verify identity into the contracts, and do a lot of synchronization among a lot of systems. That is the valuable problem that I then came upon a little bit after 2014, when I realized what I told you I realized.
You started by telling us when you started working on this, a lot of people didn't understand how smart contracts work. And I think you said before I cut you off that right now a lot of people still don't understand how they work. And I'm curious, the three of us sat down at Consensus and you said it used to be a lot of outbound outreach from you and your team, and now you're getting a lot of inbound. Can you take us into the conversations you're having with institutions? I remember you said you're having conversations with institutions all over the world, with governments. How are they understanding this fiat problem? How are they understanding how smart contracts maybe fit into the future of their business models?
It's all pretty different in all those use cases I described to you, but our industry has gone in its initial use case very heavily towards the financial market. And so there was a debate in our industry, I would say maybe 5 years ago, 6 years ago, about will blockchains be financialized, or will they be about a wide array of topics like blockchain games and insurance and supply chain. And there were a lot of people trying to work on these different use cases. I think at this point, our industry has pretty squarely become highly financialized, right? So it's extremely focused on financial products, financial issuance of assets. Tokenization is heavily focused on real world assets and the financial uses of those tokenized assets. Stable coins are used in trading venues on chain and off chain. So I think right now our industry is about financial use cases, which is totally fine and good, because there's a huge amount of value and money and problems to be solved and resolved and built on in the financial use case world. So I totally see the value of that. What that means is you really have two groups in the blockchain world. You have the DeFi, decentralized finance, 1 to 2 to 20 to 30 to 50 person team that is building a DeFi protocol. And that is basically taking a part of what would have traditionally only been allowed to happen in a bank. And it's taking that part out and building it into its own little service and to its own little application, like a lending market, right? Lending markets are a part of what banks do. They're not everything banks do, but it's a big and valuable part of what they do. And so now, oops, you have lending markets over here, and there it's a separate cutout. And does it matter what the brand is? It kind of matters, but not that much, because what you're really focused on is the contracts. right? What is the reliability and quality of the contracts? What is the track record of the contracts? What are the audits of the contracts? What are the Oracle networks and dependencies connected to the contracts to make them reliable? So that's the DeFi community. Then you have the TradFi community. The TradFi community is, I wouldn't say they're waking up. I would say they're wide awake at this point. All of this new legislation around stablecoins, market structure in the US especially, the US is a great big business. That's what the US is. The US is a huge business, and it's a heavily financialized business, basically. That's a huge part of the US economy. And that's really because once the financial sector in the US is allowed to make money somehow, they do it pretty quickly. So in the second group, in the TradFi group, I see the US banks and institutions very rapidly now looking to make their own stable coins, looking to do issuances, looking to do asset tokenization. And where this is all going to go is that first group, the DeFi group, is going to do what's called permissionless innovation. They're going to take risk. They're going to create exciting next generation ways to gain yield and manage risk against things that historically have not been possible in the banking sector. And then the banking sector will take their reliable brand and they will do tokenization, and they will evaluate all of the DeFi products, and they will select a few of them to make available to their user base. And then all of the trillions of dollars in those user bases flowing into DeFi will make it hyper successful. And Chainlink is working to be in the middle of that process to enable that from a technical point of view, with data, cross-chain connectivity, identity and compliance, and these other key aspects. And so what I'm seeing is that these two groups seem pretty different, but they're actually doing the same thing, basically, and they're very complementary. So what I'm seeing is that the DeFi group is reaching a level of maturity where more and more value is going to flow into them, into their systems. And I'm looking at and dealing with a TradFi group that is more and more comfortable and legally able to execute tokenization of funds, tokenization of equity, tokenization of commodities. And then the only thing that needs to be true is that a tokenized equity or a tokenized commodity or a tokenized fund is better than a traditional fund or a traditional equity or a traditional commodity. And this is another one of those things that I feel I understand that many people still don't understand, because you have to understand two pretty complicated things at the same time. You have to understand how the current system of equity settlement, equity issuance, equity management, equity compliance works. You have to understand how that will work in the blockchain world, and therefore the differences. Right now, I would say, once again, we're at a world where there's like a few thousand people that really understand the difference between these two worlds. Like you can find people that understand why DeFi is good and people that understand how TradFi works. You will be hard pressed to find many people right now that understand point by point how DeFi settlement differs from TradFi settlement in detail, how DeFi compliance on chain will differ from TradFi compliance off chain, how DeFi yield generation and collateral management will differ from TradFi yield generation and collateral management. And I think this is like the big moment for our industry, because if our industry blows up past 3.5, 4 trillion into 10, 20, 30 trillion, the technology will become so important that the financial system will polish it into something that can be reapplied to other industries. So what's going to happen now, in my opinion, is our industry is going to boom through the merging of DeFi and TradFi. We're going to be looking at tens of trillions of dollars in market cap. We're going to reach a point where the majority of that market cap is not cryptocurrencies, but actually real world assets like stable coins, tokenized funds, tokenized equities, tokenized commodities. That will naturally redefine what our industry is, because it will no longer be about idea coins or coins related to digital gold or Bitcoin or something, they will now be about real world assets. Our industry will become about real world assets more than cryptocurrencies, just by the numbers. And that will lead to a polishing of the technology to the point where it will become low cost and easy to adopt it for all those other use cases like ad networks, supply chains, insurance, concert tickets, real estate, and so on. And then what that'll do is that'll synchronize all of these other parts of the world back into a global financial system on chain and powered by Oracle networks and smart contracts. And that's the point at which everything is just going to run in these systems. And so everyone will then have to deal with these systems, because if you want to sell someone a concert ticket, it's actually going to be the easiest way to do it is going to be to allow them to buy it in a stable coin, because the concert ticket is on a chain and the stable coin payment is on a chain. That's it. And that's going to be how you buy concert tickets. And then, you'll be able to take the concert tickets and, I don't know, tokenize them and resell them or something, some crazy financial thing that someone will come up with, because it'll be technically trivial to do it. You'll probably be able to tell an AI, hey, build me this financial product on chain, and it'll be able to do it. And in the background, it'll be composing 5 smart contracts, 10 Oracle networks, and 500 chains together to make your financial product.
Sergey, I want to ask you a question, because I think what you're hitting on is so vital and so important, right? Once we start thinking of the blockchain industry beyond cryptocurrency, and then add the firepower of these other markets and commodities, concert tickets, whatever it may be, the unlock is massive, right? So we can think about tokenized oil, or we could talk about, tokenized bacon. It doesn't really matter, or real estate, any of these things, and it's going to benefit the industry. And I want to make sure I'm understanding this correctly. It's going to benefit the industry by saying, now that we can tokenize anything, what we really need is the opportunity that a trustless, permissionless system allows, and especially one that is immutable and transparent. Because once you start putting all of that in, you have the opportunity to say, hey, we can really revolutionize markets in general. And those could be attention markets, or those could be financial markets. And we have a way to verify the information that we've been doing proof of concepts now for 15 years to do. And we figured out how to do it really, really well. And obviously oracles are a big part of that. But is that unlock to say, because, I think your statement is really, really big, right? Which is the size of this market isn't limited by the size of the value of the cryptocurrencies that are powering it today. It's really about what are the assets that we are going to be able to record the digital internet native transactions back and forth tomorrow. And those can be massive if we allow them to be there. Is this me? Am I understanding correctly what you're saying?
So, sort of. So what I'm saying is that we're going to be looking at an industry of hundreds of trillions. That's going to begin from the financial markets and the global financial system side of the world. That is going to be based on liquidity and asset issuance interacting in markets. It's going to be about liquidity and asset issuance, about real world assets, more than cryptocurrencies. So right now, our industry is still defined by cryptocurrencies being traded on dexes against other cryptocurrencies, most of which are not related to a real underlying asset. We're going to be shifting into a world where you're going to be seeing more volume and more market cap for the amount of stablecoin purchases for tokenized funds than you're going to see for the trading pairs for stablecoins against cryptocurrencies. Now, there's nothing wrong with cryptocurrencies. I'm a big fan of cryptocurrencies, and I think they're going to grow massively as a result of all this stablecoin purchasing power and other purchasing power going on chain. But it just doesn't make sense that the whole world would get tokenized and cryptocurrencies would be the majority of this industry, because that would mean that everyone's theory of portfolio management would shift from I'm 90% in real assets and 2% to 5% in cryptocurrencies, which are not backed by any real underlying, to I'm 30% in cryptocurrencies with no underlying. That's not a realistic portfolio management view for portfolio managers and asset managers to be taking. It's just not, it's too risky for the vast majority of them to take. I can see them going from 0 to 1 or 2 or 5, some cases maybe 10% cryptocurrencies that have no underlying asset, but not beyond that. That's not likely. So if we're assuming all of their holdings are going to get tokenized, we're basically saying that barring any large change in portfolio management theory, the vast majority of tokenized things, and therefore the market cap of our industry, will be real world asset token based. That means stable coins for currencies, tokenized funds for funds, tokenized equities for equities, tokenized commodities for commodities. And what that's going to do is it's going to create a huge market and a huge amount of purchasing power where there will be people with keys that can now buy a bunch of stuff. And then the stuff they buy will, in many cases, be financial products and financial services and, various tokenized asset things, which is a great start for our industry. But once you have that much purchasing power, that much liquidity in any system, people start wondering, well, would I be able to sell more flip-flops if I was able to accept payment for the flip-flops in this form? Do people want to buy my flip-flops in stable coins? Oh, it turns out there's $20 trillion, not 200 billion, but 20 trillion in stable coins out there. Okay, why don't we turn on the ability for me to sell my flip-flops? Oh, you're telling me if I tokenize the ownership rights to my flip-flops or to my supply chain or to my insurance contract, then these smart contract things can dynamically buy and sell and instruct the buying and selling and moving of my asset. I just tokenize it and all of a sudden I have access to this bigger market. Okay, yeah, that makes sense. Let's do it. Let's do that. That's what I see happening, right? So I think once you get so much value onto the system, I think that's it. I think the rest of the world has to connect to the system in order to transact. And so that's the basic idea.
Sergey, what happens to cryptocurrencies in this future? I think a lot of people watching the interview, are embedded in the crypto ecosystem, are some of the first adopters. In this future that we're building towards, where do you see cryptos, the tokens that we interact with today, falling into place?
Yeah, so I absolutely believe that Bitcoin can go to $1 million. I absolutely believe that there are utility tokens that serve valuable purpose for certain key infrastructures like blockchains and Oracle networks, and that those utility tokens will have a lot of demand for the usage of the system for various aspects of how the systems operate. I absolutely see, that continuing to evolve. My view of cryptocurrencies really just boils down to basic portfolio management theory, which is if all of the sovereign wealth funds, family offices, hedge funds, pension funds, if all the world's capital decided to allocate 5% to cryptocurrencies, because cryptocurrencies are this new asset class thing that they have become convinced is something they need in their portfolio for growth reasons, risk management reasons, number of different reasons. And this could include central banks through cryptocurrency reserves, in addition to gold reserves. I think that calculation is the answer to what happens to cryptocurrencies. I don't think the answer is that you get to 5% and then everybody's portfolio as a pension fund is 50% cryptocurrencies, right? That is the type of world where you're saying there is such a vacuum of other assets that portfolio and asset managers could access, that for some reason cryptocurrencies are this exceptionally unique and that like all the other assets have gone completely sideways. And I'm not talking about fiat currency, I'm talking about all other real assets. But realistically, we're not even at 1% right now. So if we're talking about Bitcoin at $1 million and we're not at 1% in this calculation, we're not there. Then 5% is that million or more. So I think my views and the cryptocurrency community's views are very compatible. The thing that I think about is, where is the capital going to come from? What is the net new capital flowing in to buy the Bitcoin token? What is the net new capital flowing into these cryptocurrencies or into these real world tokenized things? Stable coins. Who's going to acquire stable coins? Why? Tokenized funds. Who's going to buy those? How are they going to buy those? Oh, they need a stable coin to buy them. Oh, okay, so that's why they're going to get a stable coin, because it'll give them access to this better asset on chain, this better form of a fund, better form of an equity. I think that's really how this is gonna evolve, and it's very compatible. I think that the cryptocurrency view, and I never really necessarily thought this was going to happen, was that our industry is going to replace the bank industry. That's not really likely. What's likely is that our industry merges with the bank industry, and there are banks that support our industry and asset managers that support our industry, and they succeed as a result of it. And then there are asset managers and banks that don't support or succeed with our industry, and they become unsuccessful. It's very similar to the internet. So there are companies that the internet came around and they jumped on it, and they became much more successful because they had an internet strategy and they had an approach. And there were companies that didn't do that. And that's it. And they suffered huge consequences from that. Some of them closed because of that, right? Bookstores are a good example.
I used to work with a lot of them. Yeah.
That's what we're going to experience now in our industry. It's going to be very net positive. So I think the more banks, the more asset managers, the more people holding stable coins, the more people buying tokenized funds, some portion of the portfolio of those people, they will say, let me buy this tokenized fund. Let me also buy a cryptocurrency in some small percentage. Their percentage of ownership of tokenized funds will be much larger than their percentage of ownership of cryptocurrencies. But because they got into the ecosystem through the I want to buy a tokenized fund pathway, they will have gone from zero cryptocurrency ownership to some, that 1 to 5% level, which is what our industry really hopes for, I think, when you think about it.
And Sergey, we can't not talk about that and recognize the fact that at the time of this recording, just yesterday, the House passes the Genius in the Clarity Act. You are in Washington as we speak. You have been a vocal proponent of the innovation on a technical level, but I think also the opportunity finally that's happening on a regulatory level. So why don't you tell us a little bit about what that journey's been like for you and where you see that going, with knowing that we are not going to go backwards when it comes to how many are going to own some cryptocurrency in some manner. And we have seen dramatically, just in the ETFs alone, all of these traditional finance companies get in and find that it's a very profitable opportunity for them and it's a very innovative opportunity for them. I can't see more not coming in for that reason. We're seeing all these different types of ETFs now being proposed. It feels like the market is ready to embrace this industry in a way it was not a year ago, 5 years ago, 10 years ago. And so what does that all mean in your opinion? And where do you think it's going with what you're able to, the people you're able to have conversations with now on the governmental level?
Because our industry is so financialized, because it is so focused on financial products, and because the source of capital for a highly financialized industry like ours will necessarily have to come from institutions, the shift in the regulator's mindset, in the government's mindset, towards our industry is hyper significant. So the thing that people in our industry have been used to experiencing has been a headwind. And sometimes the headwind has been very strong. And sometimes it has been weak, but it has always been a headwind. And that headwind has slowed down our industry in a way where people have become used to it existing. And they've come to believe, and I think rightly believe, that that headwind cannot stop our industry. Our industry will continue and succeed and grow because of the quality of what it does and the value it provides in terms of the systems and the improvements to those systems from all the ways we discussed, making the agreements mathematically guaranteed, deterministic, transparent, and so on. But now what has happened is very interestingly, there has been some kind of political disagreement out in the world. And the group that is in power in the United States, the Republicans, have very, very squarely and in a very unified way decided to go pro crypto, pro blockchains, pro smart contracts, pro Oracle networks to a massive degree. And then the other political side of the equation has looked at this and found it to be an issue, I think, that is not worth fighting over. There's a large enough constituency that holds cryptocurrency in the United States electorate. There's enough people that are going to gain it over the coming years that it is now a part of the electorate and a part of the voter base that you just don't want to go against as a politician. There just is no real value to that, in addition to all the value you would lose in campaign donations and financial support. So what does all that add up to? Well, all that adds up to a headwind becoming a tailwind. And what does that mean? That means that in a highly financialized universe, when the government and the regulators and the compliance system suddenly goes from saying this is illegal to this is legal, and now they're not saying this is legal, but this is legal, and we're encouraging you to do it. What that does is it kicks off capitalism. It kicks off competition. So why does capitalism work? Like, why do we have all this stuff? We have all this stuff because of competition, right? Because capitalism engenders competition, people pursuing their individual interests, the invisible hand of the market, all these very powerful forces. That's why, you've seen this explosion in quality of life, quality of goods, quality of many things, quality of travel, all these things. Why airlines make almost no money, but everyone can fly all over the world. Competition, right? So now what's going to happen is massive competition, because competition is now allowed. The people that were able to compete in our industry before were the people that didn't care about the legal risks as much. So startups, smaller firms, which is where smaller firms historically have been able to innovate and generate huge value, huge gains, because they're willing to take risk, right? They're willing to do things that are not clearly right, that carry the possibility of being wrong. Now that it is no longer wrong and that there are large economic benefits, massive competition. You already see huge sources of traditional finance distribution, large banks, asset managers, fintech apps like Robinhood and others, all talking about tokenization, all doing tokenization. What does that mean? Competition. You now have banks generating stablecoins, competition. You have asset managers competing with each other to make tokenized funds. What does this mean? Well, it means that once you stop trying to kill an industry and you give it the fertile ground in which it can grow and succeed, if that industry and its technology does something valuable, it'll experience competition, it'll experience growth. And that will result in more value to the consumer, value to the institutional consumer, to the retail consumer. So that's what this means. It basically means that our industry is entering a new stage. The good and interesting thing for Chainlink about that is Chainlink is technology for enablement. It's an infrastructure. And generally speaking, infrastructures tend to boom in their adoption when many different competing entities and firms want to suddenly do the activity that became possible. Like they want to generate a stable coin, so they need proof of reserves. They want the stable coin to go cross chain, so they need cross chain and CCIP. They need data for the tokenized funds in order to issue the fund. They need automated compliance and identity from identity oracles. So for us, this is fantastic. And this is why I'm in DC. I'm in DC, and we work with many other central banks, and we've published many of our work with these central banks like the HKMA and the MAS in Singapore and others, because we want to accelerate this. As an infrastructure provider, as Chainlink is a set of infrastructure standards and infrastructure services built by different groups. The more tokenization, the more tokenized funds, the more real world assets, the more stable coins, the more of all these transactions that I've described to you, the more you need infrastructure to power that. The more cross-chain events, the more data events, the more identity and compliance events. So my view is that not only is it great if I can have some hand in accelerating this in DC or in Singapore and Hong Kong or in Dubai or in these different places where we collaborate with the governments there, but it'll also be extremely, extremely powerful for making the Chainlink infrastructure something that does something more and more valuable, which is exciting. So my view is that the US's stance on this changing is going to actually change the other countries' stances. I've already seen that, because the US is something that is known as a super regulator. Basically, it's a regulator that other regulators copy and follow because they want their financial system to be compatible with the US system, because the US system is so important to their system being successful from like a consumer point of view or from an institutional point of view. Now, once the US gives the green light on all this stuff, which it now has for stablecoins, I think you'll see massive competition, massive need for infrastructure, massive need for cross-chain proof of reserves, all these things. And that's great. That's great for everybody. I think it's great for consumers. I think it's great for institutions. I think it's great for our industry. I think it's great for the Chainlink ecosystem and community. I think it's just great all around. And so that's why I'm super excited to be part of it.
I want to follow up a little bit on that, right? We talk about crypto becoming this, making US this global superpower. I've heard you say that before. It's kind of what you're alluding to now. And you started to talk about this a little bit, but where do other countries fall into that narrative?
So it's not about making the US a global superpower. The US is the global superpower in the global financial system. The question is, and one of the main driving forces of the US taking this stance towards our industry is, will the adoption of this technology increase or decrease the US's market share in the global financial system? Will the emergence of stablecoins as a method for institutions and individuals to have access to the US dollar increase US dollar dominance or decrease US dollar dominance, right? So there is no question that the US dollar is the dominant, source of transaction settlement from a fiat currency point of view, and that the US is the dominant force in the global financial system. That's an unquestioned thing. The question is, what position is the US in 5 years from now? Are all the best tokenized funds coming out of the US Web3 powered financial system, or are they coming out of other financial systems? That's the question. And so the answer to that question from the US's point of view should be 99% of all the best tokenized financial products are from the US financial system. That's the answer the US wants. The answer that Hong Kong wants is 99% from Hong Kong. Dubai, 99% from Dubai. That's what competition is doing here. And so that's great. I think what it boils down to is that the US is in a huge fight for its position as the leading global force on many dimensions. And so the Web3 and blockchain technology stack and the Web3 financial system is something that they want to utilize to grow their market share for dollar dominance grow their market share for financial system dominance, which from their point of view is a very rational thing. That's way more rational than what was happening before, which was, let's try to kill this industry, and if we kill it in the US, it'll die globally. Right? That was the path that the US was on under the previous administration, the previous regulators. I mean, that was a ridiculous
Hmm.
idea that just was proven to be untrue day after day, month after month,
Yeah.
where you had consistent growth for our industry in Dubai, in Hong Kong, in Singapore, all over the world, other than the US, right? So that's what's going to happen now, and the US as a force driving our industry into other financial systems is really not to be underestimated, because the US has so much influence over other financial systems. I mean, it's colossal. And so if the US says we prefer the tokenized funds are the next way that fund structures are interacted with from the US financial system, that's what we as regulators prefer for these risk management and identity and compliance and security and reliability reasons. I mean, that's it. The other financial systems will go to their banks and say, look, we don't want to fall behind. The US wants tokenized funds. You got to make tokenized funds. That's it. I'm your regulator. That's what you're doing now. And the banks aren't going to say, well, let's talk about it. The banks will say, okay, makes sense. You're my regulator. You're my boss. I'm doing what you say. Otherwise, you're going to pull my license and I'm not going to have a job. So that's where, that's where all this is going.
I misspoke there. Of course, the U.S. is the global superpower. I meant to say, will it maintain its position? I am calling in from New York, so thank you for bringing us home there, Sergey. We want to talk a little bit about how you want to be remembered once we reach the future that we've been talking about you building towards. What does that evoke for you when you think about that? Like, what's that legacy you want to leave?
I mean, that's a pretty deeply personal question. I'm not sure how anyone is really going to be remembered. That's a difficult thing. Some people that write the best literature and make the best art and best poetry, they're remembered in ways I think were completely unexpected to them, because at the time of their death, they weren't particularly successful. There are plenty of successful people that at the time, did something successful and no one knows who they are. I don't know if I'd say remembered. I think the standard that I want to meet for myself personally is really that I've been involved in building something that provides a lot of value to society and the average person for 50 years. 50 years would be nice. That's how long I've seen many technologies last. If you get past 50 years and with the technology that you built and it's still providing value past 50 years, I think that's a pretty big achievement. Many of the internet technologies are have reached that level, right? And they'll probably be going past 50 years. So that's an interesting standard. I try not to think too much about how people think about me. I guess is why it's hard for me to answer this directly. But my standard is, did we make something that can provide value as a standard, 50 years down the road? We're approximately 7-8 years down the road now. I think the next 1 2 3 years are going to be critical, pivotal, high growth moments for our industry, and Chainlink as a standard, powering those different parts of the industry we talked about. So once you get to a certain point of 10 years or beyond that, I think I'll sit and I'll think about, okay, what is all this really powering? How do I feel about that? But that's what it takes, I think, to build something that has a chance to go to 50 years. And if you can do that, if you can make a technology that's still powering the world in some significant way, it's like powering the majority of something. Like the people who made HTTPS and SSL and TCP/IP, that's it's a real achievement because that's doing something. It's not a theoretical thing. It's not some idea. It's a real thing. It's every day, right now for us. Even we're going forward in our conversation digitally thanks to their contributions to how the world works. I would say that is probably the personal standard I have.
Sergey, thank you so much for joining CoinDesk Spotlight and sharing a little bit more about your journey. I think the audience is really going to appreciate hearing how you think and what you're building towards. So thank you.
It's my pleasure. Thank you for having me.